Mic check. Okay.
I've been super at it 2 years, maybe a little not quite that long, but at least the past year I've been fully checked out. Like my pace is when that comes back, then sure, like get back to it, but it's like with the North American environmental market. So John and I have a partnership in that. So we have two partners and those that have got set up. We have also worked with another company cryptocurrency data centers behind the fence power and natural gas to partners there. Yeah, it can have a number of different hats. Depends on what day it is.
I think people are just enjoying their music. Do you want us to start now? Should we gather people now?
What?
Should we gather people around now?
Get up and what?
Should we gather people around now? It's like 3:30 already.
In a few minutes.
You want to wait a minute?
Well, what do you want?
Well, it's 3:30, so if you want to say, give everybody a warning and you want to grab a seat, we'll get started in just a minute. Okay.
You want to say that? You want to grab a seat or get started?
Okay. Hi, everyone. If you want to grab your seats and we can start. Thank you. Okay. Well, good afternoon, everyone, and thank you for joining us for the first session of our 4-part series on Cleantech Commercialization. My name is Ola. I'm a lawyer with EnerNext. Before we start, I would like to briefly tell you about what we do at EnerNext and who we are. EnerNext was founded in 2017 to help clients commercialize clean tech and new energy solutions. We combine expertise in climate regulation, emissions trading, and corporate law to deliver practical and strategic advice. Our overhead structure allows us to support growing businesses efficiently and cost-effectively. I'm joined today by my colleagues, John Goetz and Ashton Brehm, who will be leading the presentation today. John is a founder and partner at EnerNext. He is one of Canada's leading clean tech and emission trading lawyers, a trusted advisor, and serves on the board of several clean tech energy companies in Canada. John has been practicing law and working with businesses for nearly 40 years. Ashton is a partner at EnerNext focused on clean technology. He advises clean tech and energy companies on corporate and commercial matters, including financing, commercialization, and growth. Ashton provides practical solution-focused guidance on climate and sustainability-driven businesses. And a little bit about myself. I'm a dual qualified lawyer with license to practice in Canada and Nigeria. Before now, I was practicing in Lagos, Nigeria, advising oil and gas companies on their upstream projects and commercial matters. Now at EnerNext, I work with clients on energy and clean tech related matters. Between the three of us, we have over 55 years of experience practicing law. Let me now briefly walk you through the series outline for today. Our overall theme is exploring ways to market for clean technologies. Session 1 focuses on evaluating and selecting the most suitable monetization pathway for clean tech companies. We will outline the approaches covered in the remaining sessions and examine the strategic, operational, and financial factors that influence model selection. And session 2 takes a deeper look at direct sales and tech as a service models. We will examine how this structure operates in practice, and including key contractual, operational, and revenue considerations, as well as the risks and opportunities associated with each. And session 3 focuses on licensing strategies, partnerships, and joint ventures as pathways to scale and expand into the new markets. We will explore how this structure allocates risk, protect intellectual property, and align commercial incentives, and when a partnership may be preferable to a joint venture. And session 4 turns to monetization of process outputs and carbon credits. We will discuss how companies can generate value from emission reductions, clean fuels, hydrogen, and other measurable outputs. We will also address the ownership and claim rights and the risk of double counting and double selling. Our promise at EnerNext is very simple. We help clean technology companies structure their clean tech projects so that they are commercially viable and finance ready. With that being said, I will hand over to John now, who will take us further into today's discussion. Please welcome John Goetz.
Thank you, Ola. Can everybody hear me okay? Just going to raise this a little bit. Well, everyone, thanks for coming. It's great to see you here. Today we're going to be talking about commercialization paths for clean tech companies. Before we get started, I'd just like to get an idea of the makeup of the audience. I'm going to ask you a couple of questions, and if you wouldn't mind just raising your hand if you fit within the answer to the question, that would be great. I'm going to start with who here is part of an early stage clean tech company? Great. And who here is part of a later stage clean tech company? Who here is a funder or works with a funder? Okay. Who here is a service provider? Cool. And here's the fun question. Who here thinks that clean technology has a material role in reducing emissions and improving our environment when it comes to producing energy? Great. So you're all converted. That's great. I guess I'm speaking to a friendly audience. Wonderful. Well, I'm going to get started. So this is what I got to remember. Here we go. Great. Yeah, good. So here's the question. Why are we taking the time today to learn about these different pathways to commercialization? Well, the answer is that selecting the right commercialization pathway for your business can make the difference between surviving or perishing in the valley of death. The valley of death refers to that critical period in which a funding and resources gap exists between developing a new technology and successfully bringing it to market. The good news is that if you take the time, do your homework, understand your business and the steps that you need to take to succeed, understand the framework of the pathways that we're going to talk to you about, and then plug the specifics of your business into this analysis framework, the solution to which pathway you should take should become self-evident. At least that's our goal. It might not happen today, but hopefully over the next couple of series, we're going to be delving into 3 more seminars where we're talking about some of these pathways in particular. You'll get a lot more information. So hopefully you're able to walk away from it with a better idea of why pathways are important and which one you want to choose. And in lots of cases, you'll actually have more than one commercialization pathway depending on your business. So here's the fun part. So is everybody pretty much familiar with the innovation valley of death? It's a fairly well-known concept for startup companies, but I'll kind of walk you through it, and I'm going to take the microphone with me here. So this will be the most fun part of the seminar and also the scariest. So you start entrepreneurs here on this axis here. We have funding. And on the axis below, we have progress. So we start with the entrepreneur having an idea. He gets excited enough about that idea, or she does, to decide to do some research at it. This usually takes place in a university or a college, tech college environment, and it often involves either university or government funding. So far so good. You're putting in your time. It's being funded using these tools and resources, and you're going along quite happily. Then you decide, okay, your research indicates that maybe this idea is not so stupid, and you actually want to do a bench scale proof of concept. So again, you're still in this area where the bill's being foot by somebody other than yourself. Unless, of course, you're not in one of these institutions, you haven't applied for government funding, and you're working under your garage or your basement, which, as you know, is businesses have come from. I can name a couple, but I'm sure you all know Amazon and Microsoft. Well, they didn't come out of here, they came out of somebody's garage. So there's still hope for those of you who are still working in that environment. And the beauty of it is, at this stage, even if you're self-funded, you're not spending a lot of money, because typically your research didn't cost you much. Your little bench scale experiments probably didn't cost you too much, and things are sailing along. Now you've done your bench scale proof of concept, and you realize that, okay, hey, that actually worked. I wonder if it would work if I tried it on a larger scale. That's exciting and fun, but now you're starting to see we're crossing over this line, and we're out of money. At least we are ourselves. Now we've got to go down here and produce a larger scale prototype, and those often cost considerably more money than the bench scale, and they're very important because it's easy to prove something at bench scale, and it gets much harder as you scale up. So now you're at a prototype that's not commercial scale, but it's still a significant scale to demonstrate the principle that you're trying to establish, and it's costing you. So oftentimes here, you're still not able to bring in sophisticated investors by any means, but you might be able to rely on your bank account or friends and family investors who think you're smart, think you have a good idea, and don't know any better. So they'll throw some money in there. There's plenty of those. I've been one of them many times. From that prototype stage, okay, now you got the results you were hoping for. They're not perfect, but you think you can work on them, do some tweaks. Now you're doing a larger scale pilot. It works, or it has promising results, and it's encouraging. And oftentimes, and there's probably people in this room that'll tell you their first field demonstration unit, which again might not be commercial scale, but it's a field demonstration in a real world context. It isn't perfect, but it is providing promising results. In other words, they think they can do some tweaking and get the technology to work the way they want it to work. So now they're encouraged. They know they have to start seeking investment. This is a really hard area to get investment, because now you're starting to look towards funding agencies who have pretty in-depth review processes and due diligence, and private sector investors. And they also want something called a business model. And you may not have the money or the expertise, especially if you're a technical person, to build a business model. Now you've got to go out and hire a CFA or a business development professional to help you go and do that. So you get to that stage, you're comfortable with your business model, and now your next step is to do a commercial scale demonstration. Now we're talking big bucks in a lot of cases, especially in a hard tech environment, not so much in a soft tech environment, which we'll discuss as we go on. But now you're looking for funding, definitely from private sector, but this isn't quite accurate, because oftentimes what we have is private sector matching grant funding, or the opposite. We could have grant funding matching private sector. But for either of these, at this stage where you got this type of capital requirement, you've got to impress both of those, and impressing one will often impress the other enough to get the other one to tag on. So sometimes they'll rely on the other party's due diligence. So if you get your commercial scale demonstration pilot done and it works, you're still in business, you've got positive results. Now you're going to be able to probably get more money or have more confidence raising investment from the private sector. And hopefully you can get up to this commercial deployment stage. This is the last stage we're showing on this, but this still isn't the last stage. And I've got clients in this room that know that. They've had lots of commercial deployments, but the nature of their product is they need thousands of them, not tens and hundreds of them. And the product or the technology will often prove itself here, but you're still looking for funding to really get it to commercial scale. And so commercial deployment and commercial scale are a little bit different. Commercial scale means you're actually in business. Product reliably, you can meet demand, and you've got a revenue stream. So sorry to say that most businesses don't get much past here. Sometimes they'll be here and then they'll just languish here for years. And this can be a 10-year process, and we've seen that in several cases where it's not 1 or 2 years, it's not 6 months, it's 10 years. And the entrepreneur will often toil, oftentimes to no avail, trying to get to these higher stages, but it doesn't happen. Our experience with our clients does bear out. The roughly 1 in 10 will get out of that valley of death. So it's kind of sad. But when we look at our files that we've opened over the past 9 years, there's several of those companies that no longer exist. So we're hoping that today we can give you a little bit of introductory information as to giving yourself the best odds to get through this valley. So that's kind of our context for the day. Sorry. Great. Thanks. Okay. Now that you've seen how precarious navigating the valley of death is, here are the reasons it's critical to choose the right commercial pathway. First of all, you need to know what the amount of capital is that you're going to require. The pathway is going to determine who will provide that capital. It's going to determine the level of risk that you'll take on as opposed to the risk that your investors or your partners might take on. The reward you may ultimately receive from that, and the likelihood of achieving commercialization. We'll examine each one of these in the context of each pathway and the type of technology that's being done, i.e. soft tech or hard tech. The first pathway is a direct-to-customer pathway. Direct-to-customer basically means your company is going to be selling its product or its service directly to the customer rather than using a licensee or a commercialization partner to assist it. If you sell the product as a one-time sale, you have a one-time revenue, and you have to move immediately to the next sale to keep your revenues flowing. The product may need to be priced quite high to reflect both the value that it brings the customer or the cost of it to build the product. And the expense will be a capital expense for the customer, which are typically large one-time expenses as opposed to an ongoing operating expense. If you sell the technology embedded in the product as a service to the customer, you'll have an ongoing revenue stream, and it'll be an operating expense for the customer. Customers often prefer having smaller expenses spread out over time rather than a large upfront expense. And this is typical in the oil and gas industry, where you'll often read companies are doing their capital expense budgets for the following year. And in recent years, we've had lots of stories where capital expense budgets are being cut down significantly. So what it ends up being is it's often the case when this happens that at the end of the day, you as the tech company have to possibly have both models available. So a one-time sales model or a technology as a service model in order to meet the customer's needs for its cash flow and its ability to lay out large amounts of capital. And an interesting story that I experienced with a client almost a decade ago was they had a fantastic water treatment technology, and they had several oil sands companies interested in using it. It saved the oil sands companies a ton of money and was a giant step in how they were processing water. And they wanted to sell it to the oil sands companies as a service. And the oil sands companies, being very astute, ran the numbers and realized that it would be much more economically beneficial to them if they could just buy the units and operate them themselves. And so who do you think won that battle? The technology provider or the oil sands companies? Well, unfortunately, again, for our clients, the technology provider, they buckled and they sold the units to the oil sands firms at a value that was a fraction of what the technology saved the oil sands companies, and that came back to bite them, and they did not get through that valley of death that we're talking about. Had they been in a stronger financial position to hold their ground, they may be in a much better, well, they might exist today. But part of the problem was they were a public company, and the oil sands could buy the public company for less than they could buy the equipment. So they really didn't have much of a choice. If they were private, they might have. But anyway, I just think that's an interesting story to share with you. Next, talk about the third commercialization pathway. Hang on a second, I just want to make sure. Nope, I almost skipped over licensing, sorry about that. So the second pathway is technology license arrangements. And these start with a license agreement between the technology company and the commercialization partner as a licensee. And these licenses can take several forms. You can have I'm ahead of myself or behind myself, forgive me. There we go. You can have exclusive licenses, you can have sole licenses, you can have non-exclusive licenses or cross licenses. So there's several different types, and sometimes, lots of times, commercialization companies will have many different types of licenses out to different commercialization partners. And we'll drill down a little deeper into the details of those licenses in our next session in April. So the third commercialization pathway is partnerships and joint ventures. They're similar in concept, but they have a different legal structure for collaborating with one or more other companies. So partnerships, to start with, is a legal definition under applicable legislation, and they're formed when a technology company and a commercialization company enter into a legal form of partnership. Partnership agreements then set out the ownership and the rights and obligations between the partners in the partnership. And one thing to note about partnerships is that they may have advantageous tax treatment over joint ventures or sole corporations, and that's something we'll also delve into in our subsequent session on partnerships and joint ventures. A joint venture is a business structure rather than a legal entity. So we talk about joint ventures as if they're a thing, but they're just a structure to achieve an objective. And the objective is pretty much identical to what the partnership objective was. It's just done in a different way. So in this case, the tech company can form a joint venture with a commercialization company, or possibly a manufacturing company or a vertically integrated company. And the JV can take the form of a joint venture contract, and the joint venture contract sets out the JV partner's obligations and rights, and typically the split of the revenues or the profits. And these kind of contracts have been done in the oil and gas industry for decades. And there's joint venture departments in oil and gas companies. And in that context, they're typically working in the way where one oil company has the mineral rights, but they don't have the capital to do the development or exploration, and the other oil company has the capital to do the drilling and development. So they form a joint venture. They can do it by a joint venture contract. They most frequently do it by a joint venture contract. At least they did when I was practicing in that area specifically. And the other way that they can do it is by forming a corporation or a special purpose vehicle. And rather than having two separate companies doing things according to a joint venture contract, you have two companies owning one joint venture company jointly, and then their rights and obligations are set out under the shareholders agreement, typically in that joint venture company. So they've set up a third entity. So you see, they're still all going to the same goal, but they're just being done a little bit differently. JVs typically make more sense when an ongoing involvement of the tech company is required, especially if the tech company is needed to operate the technology system. So we'll move on to different capital requirements for each pathway, starting with direct-to-customer pathway. There are different requirements for hard tech and soft tech companies. Hard tech is basically a term for a company that has hardware assets as opposed to software assets. It typically requires higher capital and longer R&D cycles. And it usually requires a tech company to set up a variety of systems. You guys have to start reminding me to click my clicker because I'm terrible at that. Okay, there we go. Maybe I'm okay. So those systems might include manufacturing in-house or hiring a contract manufacturer to do your manufacturing. They will require inventory and inventory logistics. They'll require in-house sales teams or third-party distribution or both. And they'll require a complete business operation and infrastructure, including all the personnel to support it, and contract management if the tech company is using the tech as a service model. So in short, a lot of capital is required for the direct-to-customer model if you're a hard tech company. Now we're switching over to capital requirements for soft tech companies. So soft tech basically refers to software-based technologies. I wish I had more software-based technology clients. Sometimes we have very few software-based technology companies. We have a couple that do apps and things like that, but I kind of envy them because relative to hardware, they're in a much stronger position from capital requirements. They often require lower capital, and they have a rapid development phase with faster commercialization and entry to market. They often are much easier to test and to iterate products, versions, without having to build expensive new prototypes just because something didn't quite work on the last one. It's a lot easier to recode your program than it is to build a new expensive piece of equipment, which can also take months to build. Software can be reiterated quite quickly. It doesn't require manufacturing, inventory, or the costs and complexities involved with both of those. So often more capital spent on customer acquisition in later stages for soft tech companies after the product is commercially ready. And I have a daughter who works for Google, and that's what she does, is works with clients on how to optimize their Google use, advertising, subscriptions, and all those sorts of things. And the other company, her largest client is Shopify, that does the other end, that helps them figure out how to process all these transactions. So if you think about it, the software developers got Shopify doing the business execution and Google doing the marketing, and they're kind of sitting back collecting not royalties, but revenues from revenue that's being brought in thanks to third-party experts. Most product development costs are for soft tech programmer staff, computers and servers, versus large and more risky expenditures, as I mentioned, on physical prototypes and manufacturing equipment. Soft tech might not require a human sales team and it can better utilize digital automated sales strategies using online ads and subscriptions, similar to what I just described regarding Google and Shopify. Soft tech may not require third-party distribution relationships that can be difficult to manage and motivate. And I know I've got clients in this room right now who have dealt with third-party distributors, and you go into the relationship with high hopes. They're excited about your product. They're going to sell the heck out of it. 9 times out of 10, that excitement wanes really quickly, and it's a dud. Whereas in soft tech, it's usually easier to make it through. At the end of the day, it's easier to make it through the valley of death because it often takes more time than it does money. So that's a huge distinction, I think, between the two types of clean technology companies. There's a really interesting article I read last week, and I'll share it with anybody if you want to reach out to me afterwards, that evaluates which categories, hard tech or soft tech, has a bigger potential impact on reducing emissions. And they found that hard tech has a way higher, I think it's something like 7-to-1 capacity to reduce emissions versus soft tech solutions. So I found that to be interesting, and it also warmed my heart because, as I said, we have more hard tech clients than we have soft tech clients, and I know how hard the hard tech business can be, no pun intended. So the next thing we'll look at is sources of capital for each pathway, beginning with direct to customer. So for both hard tech and soft tech companies, without a licensor or a partner or a joint venture collaboration, the tech company has to provide the capital itself. And that's difficult, but if it's to go forward, it can be done through grant funders, existing shareholders, new investors, and or lenders. And lenders at this stage are typically lenders who sign convertible promissory notes, which means they'll have the best of both worlds. They'll lend you the money at an interest rate, and if the company's doing well, they'll convert their loan into shares and enjoy the upside of being a shareholder in their company. But if the company's not doing well, they'll call their note and let the chips fall where they may. So lenders there isn't typically a company it's not a bank that's gonna lend you money at that early stage. So one of our clients, I'll give a little shout out to Solar Steam, has just done a tremendous job of raising both grant capital and investor capital. And I always call them to say, you need to do a seminar on this because you guys have been really good at it. And I think there's a lot of other clean tech early stage companies that could benefit from it. But a lot of it is grit. Apostle, the CEO of Solar Steam, is here today, and you can chat with him and maybe bend his ear. If he's the tallest guy in the room, that's all I'll say. That'll identify him. Bend his ear as to what they've done. But just to share a little bit of their success, they were successful in obtaining capital from ISED through their ISC, which is Innovation Solutions Canada program. And it helped them install a solar thermal system at a federal building in Ottawa. And the application for the application process took about 6 months, but it included them having to get security clearance. So yes, it took a while, but that security clearance that they obtained has now helped them with getting into other opportunities, which I'll refer to in a second. They were also successful, but it does help them. They were also successful in obtaining $2.8 million in funding from Emission Reductions Alberta. So thank you, folks here from Emission Reductions Alberta that are in the room for a first-of-a-kind commercial project in Cynthia, Alberta. They had to go through 2 separate application processes for that, and it took about 2 years to get approved. But they'll agree, and I would agree, that at the end of the day, it's worth it for that kind of money. They were recently, as a result of their involvement with the ISC program, invited into the NATO Defense Innovation Accelerator for the North Atlantic Diana program, and that's a program that's going to introduce them to clean tech companies from around the world that have dual solutions for defense and civil use. So good work, Apostle. Good work, Solar Steam, and we'll be keeping an eye on you. But I use you as an example to show kind of the power of using a combination of grant and investment funding. And I forgot to mention that alongside of all this, they also were successful in raising private investment money. And part of the reason they were able to do that is because from the get-go, they were applying for grants. So every grant you get, that went through a due diligence process. And the more grant funding you have, the easier it makes your track record look a lot better with private investors, because they know that you've already been through the gauntlet with the grant funders. So again, it's a symbiotic relationship that I talked about a little bit earlier. So I'm just going to move on now to capital requirements for licensing pathway. Just trying to catch my spot here. Soft tech and hard tech typically have significantly different capital requirements, as you've heard, due to the different nature of their technologies. Tech companies, for hard tech, the tech company licensor typically develops the IP and the proof of concept, and then they begin looking for licensees to commercialize it. Licensees typically take over the manufacturing and the commercialization of the technology, sparing the licensor the risk and capital required to complete product development and set up manufacturing and sales. The licensee typically has capital, established market access, and infrastructure it can plug the product into. So another story, one of our clients that does carbon capture and utilization, Clean02, they've been working with us for almost about a decade now. Clean02 has been very successful at licensing and obtaining early capital from their licensee. They entered into a license agreement with Tokyo Gas about 4 years ago. And Tokyo Gas is the largest utility in Japan. And the license gave them access to the Japanese market. It gave them an initial sale of several units so that they could test the product. They bought a lot of test units, I'll put it that way. But the greatest part was, without Clean02 having to spend any money, Tokyo Gas acted like a true partner and engaged their engineers to do 2 years of testing and development on Clean02's technology to ensure that it worked in the Japanese environment. But in the process of doing that, they also found items that needed to be tweaked and fixed. And so they got 2 years of free engineering from some of the best HVAC engineers in the world. That was a real bonus. So one thing to note when you are dealing with the Japanese is if you're thinking it's going to happen fast, it's not. It's extremely slow. They're extremely careful, but they're also, in my experience, not just with Tokyo Gas, but with other Japanese firms, they're very, very honest, and they don't commit to anything that they're not going to do typically. So if they say, getting their commitment's really hard, but once you have it, it's worth something, which is really the opposite of my experience with other countries. And I won't name any, you can guess. Anyway, most recently, Tokyo Gas was just successful at doing their first commercial deployment of a Clean02 unit in Japan at a development that's led by Japan's largest railway company. So that's super promising. If that commercial deployment works, I look forward to Clean02's prospects, because not only will they roll more out and really get the project going in Japan, which we've been waiting a long time for, but other utilities around the world will take note. Okay, now I want to contrast the capital requirements for soft tech. It's really short. got way behind here, guys. Sorry about that. Okay, so since less capital is typically required for product development and deployment of soft tech, licensing actually may not be the best avenue because it could reduce the revenue for the licensor without providing a commensurate benefit to them. In essence, they're really not as useful in most cases. An exception would be where you have a situation where you're licensing an enterprise software to a customer that wants to use a modified version of it to commercialize in a more specific target market that it has access to. So they'll be taking a license of your technology and expanding on it to specifically fit their customers' needs. And we have a client that's done exceptionally well on a mining document management software. Just a little, again, 2 guys out of their basement, and before I know it, I'm drafting contracts with the biggest mining companies in the world. And it's really cool because some of them are able to use the platform as is, but some of them want modifications, and then some of them want to say, well, we want to use it for this too. So it's really exciting. And again, didn't cost these guys much to build that software, and their revenues are pretty impressive. So the sources of capital for soft tech companies and hard tech companies. So licensing may provide a major benefit in the case of hard tech companies, like the example I just mentioned with Clean02. They got upfront capital from the licensee, but typically the licensee takes the burden of the capital for manufacturing and sales and operations. So it's usually borne by the licensee. It obviously depends on the arrangement, but in hard tech, if you have a technology that's patented, it pretty much has to be patented for a license. That's the other thing to note. If you're not going to be able to take advantage of a license if you don't have patented technology, because they're not getting anything for the license. They need that IP asset that's held in the patent. So if you're just trying to think I lost my train of thought. If you're licensing, you definitely need to have a patent underlying your technology. It's really difficult to license trade secrets because once you let the trade secret out of the bag, it's out of the bag. You really you need a partner, or you need to do it yourself. Oftentimes, if your technology takes the form of a trade secret. So now we turn to capital requirements for partnerships and JVs with hard tech. And it's similar to a licensing pathway where the tech company typically develops the IP, including the patents, and they may develop a non-commercial scale pilot project like we showed on the Valley of Death chart earlier before looking to find a joint venture partner. The CapEx relating to these early stage milestones is typically fairly limited and often done in universities and applied science colleges, et cetera, and is eligible for grants, as we talked about before. The largest CapEx at this stage, even with hard tech companies, is probably applying for your patents. That can be a expense for companies. I'll use one last example to kind of illustrate this point. We have a solar technology client that has a very promising technology for reducing the amount of land space that's required for a solar array to produce the same amount of power. Their thesis is they can almost reduce the land requirement by half, which when I heard that, I thought, okay, well, that's a winner. Let's go. But funny enough, they had lots of early discussions with potential partners that were okay until, do you guys have a patent? No, we've applied for a patent, but we don't have a patent. Okay, well, come talk to us when you have a patent. Lo and behold, we get a patent in the US, we get a patent in Japan, and now they'll resume conversations, but guess what? The next step is we want to see a demonstration pilot to prove this out. And the CEO of the client's Stella Power, and the CEO is is a pharmaceutical executive who spent most of his latter career working with a Calgary-based pharmatech company, raising capital for them. And he said, John, they always move the goal lines, and when you satisfy that requirement, then they lay out the next one, then they lay out the next one. And I had to convince him that we had to do this pilot. We're not going to get around. And the reason I did that is because we don't have a client with a clean technology that hasn't had to do a pilot. And typically you want to do a pilot because I don't know about you, but if I was an entrepreneur and my client, they should want to know, does this thing really work? And when we have clients, which we do, that don't want to do a pilot, it makes me uneasy because sometimes inventors can literally be scared of the answer. They're scared of failure. They'd rather pursue something for 10 years than get a no after year 2. I don't know why that is. It's an actual phenomenon, but I've experienced it. But anyway, the good news about this is that now they've spoken with a technical college in Alberta, and they're now working on doing a pilot with that technical college. And the great news is the technical college is in need of the technology. They want to increase the renewable energy production on their campus. They have limited space, and they are going to apply for the grant funding. So it's a win-win-win. They'll start with a small pilot and then move to a larger commercial scale if it works as hoped. So that's kind of a happy story I wanted to share. And as with the licensing pathway, partners typically take on a lot of the capital burden with partnerships and joint JVs, and it makes it easier for the technology company to raise its share, both for grant funders and investors. So as I was saying earlier, if you have a partner that's willing, that's credible, and is willing to put up cash, it does make getting grants easier, as I'm sure our grant people in the audience would agree. And matching is often a requirement for a lot of grants these days, so you pretty much have to have private funding matching if you're going to get grants. Partners and JV don't forget to switch. I need an assistant just for this job. Okay. I'm going backwards. No wonder I'm not that far behind. There we go. I admit to being embarrassed, so forgive me. Okay, so just continuing on with hard tech. Partners and JV partners usually come in after a successful or promising pilot, and they use the capital either to further develop the technology or to run a commercial scale pilot. They may also provide the first commercial scale site for the commercial scale pilot in hopes that the tech will be proven at scale and then adopted by the JV partner or the partner. The partner or the JV partner often has a need for the technology themselves to operate it in their own business, or they may have customers that need it. So I'm going to end my part of this session with my last story, which is one of our clients is in the process of completing a joint venture with a large gas utility in the Northeast United States. And it's a really symbiotic joint venture because the utility wants to provide its customers with an ability to burn their gas and reduce the amount of emissions associated with doing that. They're under incredible pressure from regulators and building property owners to regulators in New York, for instance, have legislated that you can't have gas-fired heating appliances in new buildings. And so they saw that and they said, okay, there's the writing on the wall. This is going to domino at some point and we're going to be in a bad position. So they decided to install 2 of the company's units in their building. That went well. And then they decided, okay, let's do a joint venture and we will we'll invest a few $1 million to complete the development of the next version, which was going to be a step up to up to 50% carbon capture from buildings, which in my view is pretty significant. It's really frustrating when you hear people say, you're only capturing 20%? Well, that's not material. Well, come on, guys, it's 20% more than we were capturing yesterday, so let's get at it. It's really frustrating for clean tech entrepreneurs who don't have a silver bullet right out of the gate. Whereas with these guys, yeah, they started at 20%, but with this joint venture, the whole idea is to fund it, get it up to 50%, and then roll it out to their customer base and prove that it works. And they're going to put together a special financing program to launch it so that all of their customers can get no interest financing and 50% paid for by the utility just to install it. So that's a game changer for that customer, and for that client, and you'll probably hear an announcement about it in the coming month or so. But that's where joint ventures can really be helpful. So my thoughts on this will be summed up in the conclusion, and I'm going to turn it over to my partner, Ashton, because I think I've gone a bit over time. That's what happens when I tell stories. But thanks for listening to that part, and I'll catch up with you in a few minutes.
All right, thanks, Graham. So I'm going to walk you through kind of the risk allocation and reward between the different pathways, and at the end kind of go through a bit of a model that we can use to pressure test which particular pathway you have in mind and whether it's going to actually be a good fit for your business. And so just make sure you're actually on my side here. I'll do what John did. So for direct to customers, typically whether you're doing an actual direct sales or you're doing an as a service offering, that's going to require more capital from you as the tech company, and as well for you to carry more execution risk than if you were to go down the licensing or the partnership/JV pathway. And so you're really looking at running the full end-to-end of your business under this model, and that would include sourcing all of your own necessary capital, having the assets, the infrastructure to do it, the talent both internally and externally, as well as market access, sales capabilities, feedstock, and so on, in order to go from that concept, in order to being able to directly sell to your end customer. And so you're really taking on a very broad role under this pathway, and a lot of the risk comes from being weak or not up to par in any of those particular areas, and then your business suffering accordingly versus going and finding a partnership to handle that aspect or a licensee. On the flip side, the reward though to the direct to customer pathway is typically going to be, you're going to see greater financial reward. The caveat here being with successful execution, and that kind of flows through all of these pathways. If you're going to poorly execute on any one of them, then you likely would have been better off, or you're unable to execute well on any one of them, even if it seems like it's a better fit. You may be better off going with the pathway that you're actually going to execute on successfully, rather than the one that looks better on paper. And so part of the reason why, if you go the direct sales pathway, the first and most obvious one is nobody's cutting into your margins at all. If you have a licensee or a partner, they're in some way, shape, or form taking a cut. But also you're going to have more close relationship with the actual customers. You're going to hold that relationship, and you're also going to get more direct market feedback to yourselves on your product. You'll have greater pricing control and strategic flexibility, and better able to take advantage from the scale and repeat business. And something that kind of layers over top of all of this is there's some simplicity to this, whereas if you start getting a number of licensees or a number of partners here and there, and the time eventually comes where you're looking to exit, to package all of that together and sell it is going to be a little bit more complicated than if you just are the one doing everything end to end under a direct sales model. Not impossible, but it's just you're going to have to work more with whoever your acquirer is on getting them up to speed and understanding the risks and everything involved in what you're doing versus a direct sales model. But the key factor with going under the direct sales model is really that the tech company retains control over the commercialization outcomes, while they're also having to carry that, again, capitalization and execution risk. But I guess I'd close on this little point by saying this still can be better than managing a partnership or licensing relationship that's went south. The amount of time, even from the few instances we've had where our clients entered into such a relationship and things have went off the rails for one reason or another, and then it's months and months of both our client's time, my time, and John's time in order to try to get things back onto the right track, if that's even possible. And during that time, the business isn't moving in any particular direction at all. It's stalled out, maybe even taking steps backward, having reputational harm, you name it. And so there's always this balancing act between, okay, can you do it yourself? Can somebody else do it if the other person can't do it well? And all of these things are going to need, I guess where I'm going with it, so need to be weighed together all at the same time in making your decision. For licensing, I think I skipped a slide ahead. Yeah, so licensing, oh, I'm going the wrong way. Okay, I see what you did, John. Okay. Can I help? Yeah, you might need something here. So for the licensing pathway, while John's fixing the slides, that's typically going to require you as the company to have less of your own capital in order to execute versus a direct sales pathway, as well as you'll be carrying typically a lot less of the execution risk. You'll actually be handing off a lot of that execution risk onto your licensee. And so the tech company, they're typically aiming to find one or more of the following attributes in a good licensee. And that can be capital, is one of them. And so what we've seen a few of our clients do, and is becoming a little more common, is they'll identify a good potential licensee to go and run with their technology, where they'll hand the keys, here's the product, here's the keys for you to go and run with it. A specific market or segment where that licensee would be strong in, and they say to the licensee, okay, you're going to fund this particular market or segment, and then that takes the burden off the company in order to do that, especially during a time where they're focused here, there, and everywhere and don't have time to focus on the Baltics, for example. And then the other aspect, which is nice for the company, is typically there'll be a licensing fee that's structured with that, where the tech company themselves at the signing of the agreement or shortly after will get an injection of cash funds back into the parent co that they can then continue for product development and advancing whatever markets they are running themselves. And so that's one reason we've seen people go the licensing route lately when it comes to capital. For infrastructure and personnel, we see some of this as well. One example that comes to mind is we had a client and they were looking to do a project, but the project and where the feedstock was located around it really required them to have this First Nations group as a partner and access to the First Nations group land. And then as well, it just so happens that this First Nation group had a very strong and talented labor force that would be applicable for the project. So there was kind of a good match made in heaven there. But without having access to the lands that made the logistics of getting this feedstock and the outputs to and from where they needed to be, the project just wasn't viable. And so in this case, licensing the project and the tech in this small instance to this First Nation group to run with it from there, with their support, was the only kind of option forward. Market access would be another quite common one, where sort of similar to where I was going with capital, but you'll have somebody who's very well positioned, whether they're in an industry that's hard to get your foot in, or they're in a geographic region that you're just not familiar with and isn't on the top of your radar, but you kind of want to get a foothold in that market. You're able to almost pass off your portion of the business to the right people to go and run with it there, wherever it happened to be, let's say Colombia or Peru, where they're going to take your solution and run with it in just that predefined area within the boundaries that you kind of set up. As well as, I guess, yeah, specific market segments too. You might see where, like, okay, we're pursuing this our solution for this application, but it could also be used for mine site remediation. But that's so far, that's 10, 20 years down the road for us, if ever that we're going to chase after it. But these guys can do it for us today, and all we need to do is be able to handle the solution in a nice package for them. And so under this licensing path, though, once you kind of started down the path and signed the agreements, your role is going to become a lot more limited. You're going to take a step back and you're going to largely be outside of any regions or domains that you're still running. At least within that relationship, you're just focusing on product development, improvements, some technical support to your licensee, and then otherwise just kind of supporting them in really in any way possible. You're going to be getting questions and requests from all of them all the time, and like your fates are very much interlinked. Their success is your success, so you want to see them succeed. And so you'll really be kind of putting on that, okay, let's help these guys out and make sure that they're able to get off to the races, because it's what benefits us in the long run. And all of this, ultimately what it really means is that selecting the right licensee is of utmost importance. Because once that deal's signed, you're going to be handing over a lot of the execution and decision-making to the licensee. You could put boundaries around that in the agreement, but if any licensee who's going to want to do this is going to have a fair bit of autonomy within some reasonably defined rules to be able to actually go and run with what you've given them. And kind of like I've mentioned, without doing this due diligence, you're just at a lot greater risk of having something come up or go wrong later on in the relationship that you maybe would have been able to discover earlier. And now yourself, your team, John, myself, are spending months and months and months of trying to either unravel or find a solution to make this relationship work that could have likely been avoided if you just would have spent a little bit more time with diligence up front versus like a few meetings with the people, and you're like, yeah, I really like these guys, they seem great, I love everything they're telling me. But digging in past that, asking other people what you know about them, and really trying to uncover the full answer on these guys will go a long ways in order to avoid finding yourself in that tough position in the first place. And so this first steps that you take, that due diligence step, is the most important step. And in many cases, choosing the right licensee is actually more important than having like the perfect terms for your license arrangement. Like if you had to choose between two options and one was giving you better terms and the other licensee was less attractive economic terms, but were so much better positioned to exit and you're a lot more comfortable with them, had the confidence with them, you probably would be better off going with the licensee that's giving you the worst terms, but you have a lot more confidence on execution and that there's not going to be headaches and all these other things that come along the way. Because once those things come along, they're a very substantial burden. And I guess I would close like two other points, I guess. So yeah, the right licensee, they'll be able to accelerate things for you, but the wrong one, you can expect potential delays for years or worse, reputational damage from things that they've gone out in the market and done on your behalf that you just won't really be able to roll the ball back on easily. And then one more point on this slide is so like the highest likelihood of entering into one of these licensing relationships where it's actually going to work is that both parties that are coming together have their ducks fully in order. And so for the tech company, often they'll be providing some type of solution, and having that solution mostly baked without any remaining kinks in it is going to be very important. If it's half-baked and there's a lot that still needs to be figured out and then it's given over to somebody else to run with it, they're not going to be able to run with that thing. They're not going to have probably that same level of understanding of the tech. And so if you're giving that to them, expect some road bumps to pop up along the way. Similarly, if your licensee, they've maybe told you, oh yeah, we can find money here. They don't have the money themselves, but they're like, oh yeah, we can easily go out and get the money here and there and everywhere, and we know the right people, and they're making all these promises to you, but you don't actually have anything concrete to show that they're able to do this. You'll end up going down this road with them and end up getting dragged down 4, 5, 6 months of time that eventually becomes pretty clear to you, hey, these guys are never going to find the money, they're not going to be able to do this and all that, and we spent all this money on legal up front and all this past half a year trying to pursue this thing that's not going to go anywhere, simply because they didn't come to the table with their ducks in order, and what we did. And it goes both ways, and things get messier if both parties are partially. Usually the more common example is parties are mostly there, but don't fully have their ducks in order, and things can still work out, and you just got to work through the road bumps. But the closer you are to having your ducks in order, the better. When it comes to the reward, so typically versus a direct sales pathway, when you're licensing, the reward is going to be less, but it should be quicker, and there should be some more certainty to you getting to that reward at the end of the day. And so what a financial kind of arrangement with the licensee would typically look like is you're going to be pursuing some type of project or domain or geographic region that'll be carved out, and then either the income or the profits from that endeavor will get split up between the parties in one way or another. And so the licensee is taking a cut of the business. You could have maybe ran that business all on your own, but that again comes back to how well can you execute on it? Do you have all those pieces of the puzzle in place to do so? And if you don't, then you might be better off going to a licensee who does, so to reduce that execution risk, as well as getting you there quicker versus developing it yourself, and more certainty, knowing that something out there already exists that is capable. And the exact terms when it comes to those like financial arrangements and splits for when you're licensing, it really varies with what contributions each party is bringing to the table, as well as the risk. And so if it's the 15th licensee in a row and there's been 14 others that have come prior, and you're giving these guys a specific region here, and you can show them, hey, 14 others, they're doing great, that for the tech company, that split's going to look a lot nicer than for the first guys that come along, where maybe this plug that needs to happen, there's some kinks that need to be worked out, and so on. The reward for the tech company, or the split that they'll get, is likely not going to be as high as the later on ones. And same with contribution. If the other party is bringing in a substantial amount of capital, you may expect to see less than if they weren't bringing in a substantial amount of capital and maybe just had some assets or things of that nature you needed access to. And so there's always that negotiation that goes on there, and a push and pull both ways. And so when it comes to partnerships and JVs, John's kind of alluded to this, but there is some similarities, or substantial similarities between them. Kind of one of the ways I like to conceptualize it in my head is, rather when a licensee, you're kind of handing over the keys. Here, you can run my business in this particular domain or in this particular geographic region. For JVs and partners, that can be the case, but it's more common that they're just getting a particular subset of your business, and that they're helping you get to the destination quicker and with a little more certainty, rather than doing all of the work of actually getting this particular segment to the destination. So you're still remaining a pretty active and involved part of the business, and the other party's involvement is a lot more limited and nuanced. And so similar to licensing at the tech company, you're often going to be looking for a lot of these kind of same things in a partner. You'll be commonly, like every startup's always capital shy or capital lacking. You'll always be looking for your partner to bring capital where possible. Technical expertise and manufacturing capability is an interesting one. You see a number of things happen here, but one of the more common ones I would say that we see is there will be a project that's out there that requires a particular solution, and you as a tech company have part of the answer to that solution, but not the full answer. And you know of another company out there that has the missing piece of the puzzle. And so the two of you will partner up on a particular project to combine your clean tech stack and then offer the solution that way. And so that'll be one example where you can maybe go out and develop whatever their part is yourself, but that's going to take you time, money, capital, and so on, versus just finding somebody else who's already doing it well, partnering with them for this particular project, seeing if it goes well, and you divide up the split according to what you've negotiated. Market access, this is sort of similar to what I was just mentioning, where you may find somebody who has a foot in the door already within a particular industry. So maybe your technology produces a certain process output that has use in building materials or cosmetics, pharmaceuticals, you name it. But that's not really like chasing down these like sub-industries isn't really like your main focus, and you don't have the resources and bandwidth to do it right now. But company at Lafarge, for example, does. They're a very big cement company. And so you're able to maybe hand that off to a department within their company to take whatever output of your solution that's been developed to see if there's something there, versus just chasing that down your own. Because you'll have to, one thing we've noticed with some clients is you'll eventually get decision overload, and there'll be so many different of these verticals that you can chase down, and you kind of need to pick which is the most attractive and likely for you, and then find ways to deal with the other ones, either putting them off or finding a JV or a licensing arrangement that works for it. And then there's also infrastructure and personnel that you may seek to partner with somebody on in order to get access to that. So I guess one interesting story to add to this is on the market access, which is sort of similar to what I alluded to, but we had a client that had a process that developed a critical material for EV batteries, and they ended up partnering with Toyota, And it wasn't just for market development, but it was also for the actual commercialization pathway and helping to build that out. And so Toyota ended up helping them out with determining that the critical material actually worked in EV batteries and how well, what indicative pricing could maybe look like, volumes, who the market players were outside of like the Toyota group of companies, and kind of a go-to market strategy for actually going and reaching out and selling this critical material. And so in that case, Toyota for our client ended up playing more of a partner than just a distribution channel that a lot of people would traditionally think of when they think of a partner. But again, I guess I would just circle back to like one of the keys here on going down this road is to get there faster and with more certainty. You may be able to do it yourself. You likely can do it yourself. It's just how long is it going to take and how much is it going to eat into the other things that you have on your list to do. So similar to licensing again, although the partner is likely going to be handling a smaller portion of your business than you handing over the full keys for them to run a larger aspect, it's still very critical to do your due diligence. You're likely relying on them as a partner because there's something you either currently can't do today or don't have the resources to do. And so if you don't do your proper due diligence and go down the road with these people, you'll eventually get to a point where if they drop the ball, you'll be left in an even tougher position where you still don't have those capabilities and resources, but you have something that you need to achieve. You likely have more constrained budget now and are under like various pressures from delays and things of that nature. And so getting it right from the outset and doing that very deep due diligence is super important. And I guess to add to this, it's worth mentioning that a partner, this is along the lines of that example I just gave. So the partner, they can contribute their experience to assess the product and whether it's technically sound, the price is right, and if there's a good market fit, and that's like squarely within that partnership between our client and Toyota that I just mentioned. But again, like I just want to come back to, and I can't stress enough that doing that due diligence and doing more than you think you need to do should be done. You won't regret doing more later, but you will definitely regret doing less when you're sitting there and you're kind of looking back on things and you're like, oh shit, like it was so obvious, all the signs are clear now when I look back, and like I kind of had this feeling at the time, but was just not willing to trust my gut on it. Trust your gut in those situations, it'll save you. So for award, the partnership / JV, I would kind of put it in between direct sales and licensing. You're still in that realm of having to give something up to your partner, which again is traditionally going to be either income or profits of some nature or some percentage of that. It doesn't have to be that. You could come up with something creative, but I've never seen it not be that. But I always like when clients are creative and come up with different ways of doing things that make a whole lot of sense. And then again, overall, the key objective here really when it comes to these partners is to reduce risk, to reduce that execution risk, to make it more likely that you're going to achieve that commercialization at the end of the day, that you're going to have a fixed budget and that you're allocating whatever resources you have efficiently and to the best places that you're able to utilize them, and that you're able to get to where you want to go with some better speed. And then concluding out my part, I guess, would be with kind of pressure testing these pathways. So you've kind of have like a bit of an idea of like what your different options are, and keeping in mind, like don't feel like you have to fall within one bucket. I would say, and I think John's already mentioned this, it's maybe most common to see some type of hybrid of everything combined in a way that really fits your business. But at the same time, it needs to be understandable by both your client, because if it's super confusing and hard for them to understand what's doing, you're going to run into roadblocks there, as well as financing sources. If you're ever going out and a financing source needs to understand, okay, how are you actually seeing revenue? How is this priced? So on and so forth. And it's confusing. That's going to, like, again, roadblocks and delays. But before selecting your pathway, you should pressure test it. And these are just a few things you can do to kind of pressure test it. One would be to ask what your customer really needs and wants. So is your solution doing something that's going to kind of save them on a cost of some sort, reduce a risk for them, or unlock value of some nature? And so I guess coming back to maybe one of the examples John gave of New York, where like reducing risk may be by having these units installed, there's less a chance of this legislation snowballing from New York to other jurisdictions because the solution's already in place where the legislation isn't required. That could be a part of the reducing risk. And so really kind of fully understanding what value your customer's getting from the solution you're providing, and then ensuring whatever pathway you choose really reflects and captures that value best for both parties. And then understanding how your customer buys. And so if your customer has a lot of CapEx available, and your product is fairly standardized, where there isn't a lot of adjustments from customer to customer, then going with a direct sales approach might be your best option. Whereas if CapEx with your customer is quite constrained, maybe, and in particular in cases where there's a lot of maintenance or ongoing service work for whatever your solution happens to be, then an as-service model might make a lot more sense for you and your customer. Who should this solution be owned and operated by? And so this really comes down to, what does your customer care about? Do they care about getting a result at the end of the day, or do they care about having assets, like an asset that's sitting there that they own on their books on site? Is it both? What's the mix between the two of those two? If it's just results that they care about, then going with an as-a-service model will often keep that technical and operation risk with you as the tech company, who should be in the better position to manage it than where if you were direct sales selling your product here, it's installed. Best of luck. If you have any questions, call this number type of thing. Rather than that, you're taking a much more hands-on role of actually making sure things are running smoothly and taking it out of your customer's hands and as a stressor off of their kind of book. And then how to handle the sale of / ownership of technology outputs. And so first, you should really take a second and take stock and think about what process outputs you have, both physical, so this could be things like a biochar, a bio oil, some type of renewable natural gas, and so on, and environmental attributes, simple things like carbon credits, taking stock of all of those. And then you should confirm the price and how reliable that price is. Is that the price you're likely going to get when you go out to market? What volumes have they been sold at? What's the size of the market? Can it handle how much you're able to produce? What's the logistics of you getting it from place of inception to your end customer? Does that kill economics? Is it realistic to do that? Who are the market players? Is it a large variety of them? Is there 2 companies only and you're going to have maybe a more difficult time getting a foothold into them? All those types of things you should kind of run through at that initial assessment, and then funnel that back into your decision of what model makes sense. And then coming back to, it's likely maybe going to be some type of hybrid model, and we've seen a variety of things where there's a direct sale, but the actual ownership of the outputs are separated from the direct sale of the equipment, and the tech company holds on to whatever those outputs are, and they're selling them as an additional revenue source in addition to selling the equipment, because their customer doesn't care about what's spitting out the back of the machine. They just care about the result that's happening on the inside. And so these like ways of thinking about different hybrid approaches to do it is something that I guess should always be on the back of your mind. I've likely missed a few things, but I think I'm probably running out long on time, so I'll turn it back to John to finish us with conclusions and I guess wrap it up. Yeah.
So we are a little bit over time. I apologize for that. I'll make this conclusion quick. You've probably heard most of these things throughout the presentation. But in our view, the direct-to-customer pathway is the most difficult. It can also be the most rewarding, but it's got a lot of risk and takes a lot of capital. So it takes the most capital, highest risk, lowest likelihood of success. That's been our experience, and I think it's just consistent with 1 in 10 early stage companies surviving. As I said, potentially highest reward. The nice thing about it is you have the most control and most independence, and sometimes that's the number one factor for certain entrepreneurs, and they value that over everything. They're more than happy to take the risk. And so in that sense, you have potentially the highest satisfaction. Licensing pathway, in my view, it's often the least difficult because honestly, you've just built your IP, you've secured it with patent and now you're licensing it away and looking forward to lying on the beach in Barbados collecting royalties. I tried that once, it didn't work. It blew up. I was young and stupid and optimistic, and I don't know, sometimes I still am, but anyway, it does take the least capital. It can make raising capital required easier, because sometimes you still have to raise capital even though you're doing a license. I think it's potentially the lowest risk. That's totally dependent on selecting the right licensee, though. If you select the wrong one, you're dead. Potentially the lowest financial reward. Again, you're taking a percentage of profits. You know, it might be 10% or something, so you're not getting 100% of the pie like you would if you were owning the whole enchilada. You have the least control, as Ashton talked about, and potentially the least satisfaction. And I'll speak from my experience and clients' experience. It's very dissatisfying to be locked into a license where the licensee is not performing, and you don't have the money to take them to court or terminate the license. So partner pathway, easier than direct to customer, reduces capital required for the tech company. It can make raising capital easier, so that to the extent the tech company has to raise a portion of the company because they have a partner, it's easier for them to do. It lowers the risk. It increases the likelihood of success. Again, our baseline is the direct to customer sale approach, which we view as the highest risk. The reward is commensurate with the risk and contribution that you're making, and you maintain some control. So that is it for us today. We have session 2 coming up, and it's going to cover these things. We'll leave this up for you, but I'm going to have Glenn from CRIN come over and talk to you a little bit about CRIN. And then if you still want to do Q&A, I'm happy to do that. If you just want to grab a drink in between, I highly recommend that, or something to eat. But I'll give it over to Glenn.
All right. Thanks, John. Thanks, Ashton. Thanks, Ola. Very good. Very interesting to hear the perspective from legal counsel advice on some of these things. I've been to a lot of sessions over the years, where there's lots of advice to innovative startup companies and how to the different models to run their business and whatnot. But that perspective of sort of the agreement structure and what that means is really just a different perspective. Bradley and I were sitting at the back and sort of in the gallery, thinking exactly that. So thank you so much. And CRIN is very proud to be a host for this series and events like this, along with the ETC Foundation that we're sitting in. And I just wanted to ask, at the beginning, John asked about the audience, and who's at different stages or whatever. But I guess a question I have for you all is, for how many of you is this your first CRIN-hosted event? So a fair number. How many of you are members of CRIN? Okay. If you're not a member of CRIN, I'll have a slide here in a moment to tell you how to become a member. It is free, so it's not like it's a big barrier to entry. But then you'll get exposure to events like this through our newsletters and through our LinkedIn and social feeds and such. But if you're not that familiar with CRIN, just really briefly, we're a not-for-profit. We're funded by the Government of Canada through the Strategic Response Fund, as it's called now. And our mission is to enable the development, commercialization, and adoption of innovative clean technology solutions in the oil and gas space that can be applied to other hard-to-abate sectors. And we do that through direct funding of projects, through the support of the federal government's funding. We've had we've had up to $110 million to work with so far, and we're working to get more. We also do it through network activities such as this. And we bring together people from different parts of the clean tech economy. We have the adopters, the funders, the innovators, the talent, and supporting services. And we consider folks like EnerNext to be one of our supporting services. And there's 7 technology themes that are areas of focus for us. And, again, we're just super happy to have you here and have you be part of what we're doing. And like I said, joining CRIN is easy. There's a QR code here. You can come talk to any of us in the room who are team members for CRIN. We got Lindy in the back and Ann and myself. But like I say, it's super easy.
I probably won't belabor it more than that. We have time afterwards to network. And actually, if you want to do Q&A, we can do the Q&A here live maybe first, and then we can break. Anybody who's online can participate in that Q&A, and then we can say so long to folks online. And feel free to stick around. There's still beverages and food available. So thank you all, and we'll open it to some questions.
Thanks, Glenn. Guys, feel free to get up and grab a drink. Don't want to keep you hostage in your seat. And all I ask is that if we are going to do a little Q&A, just as you're grabbing your drink, try not to engage in conversation while people are asking questions and we're answering them. But definitely don't feel like you have to sit in your seat. So if you're thirsty or you need a quick break, please take it. So I'll take the first question. If there's one from anybody here, I'd love to hear it.
Thank you for a great presentation. Apostle Radov with Solar's team. The question I have for you guys is, how should we think about warranty of the systems that we're selling, whether we're considering a direct sale or as a service model?
Great question. Yeah, so if you're doing a direct one-time sale, you are going to have to give a warranty, and it's pretty hard to know when you're first getting started what your warranty claims are going to look like, because there might be some bugs in your technology that you're not aware of. So ideally, when you're pricing your product, keep that in mind and leave a buffer in your margin for warranty claims. I can't tell you what that is. It's going to depend on the tech. But the safer approach to that, if you're able to do it, is if you're able to do your technology as a service, then you're in a position where you can say, well, Clean02 gives a lifetime warranty on the unit, because they're entering, that's if they enter into a service agreement with the company, so that they know that they're going to be servicing that unit on an ongoing basis. And if they have to replace the unit, they'll do it, because again, they're going to recoup the cost of that warranty unit under the servicing agreement that they had. So there's a couple of ways to look at it.
Other questions?
This is just for my own curiosity. I'm really curious about why that water treatment company went public at such an early stage.
It predated my involvement. Worst decision they ever made. One of the most promising technologies I've ever had the opportunity to work with. Saw a real-world demand for it. Literally, in my view, could have solved a lot of the water problems out there, both industrial and domestic. It was incredibly energy efficient, and the wrong people in the company decided it was a good idea to take it public at an early stage and make a quick buck. And so I would go down to Cleantech conferences in San Francisco with all the major partner investors, Veolia, the name, you name the biggest companies in the world that have anything to do with water or clean tech, and they would hear the story and they'd say, we'll invest. And then you tell them you're a public company. Oh, sorry, we don't invest in public companies. And that was the end of the discussion, no matter how good the tech was. And I couldn't understand that at the time, and I still don't know that I do. But yeah, it was just a terrible decision. So this is unrelated to our topic today, but if you're a clean tech startup, I strongly recommend against going public. It's just, you lose so much control, you lose so much focus worrying about your stock price and doing disclosure, and you are better off, in my view, to find a partner that ends up being your exit. Because if you have a partner and the partnership goes well and the product or the technology takes off, and that partner has 10 times or 100 times the pocket size that you do, guess what? They're going to buy you out and you're going to have a nice exit. And if they don't, their competitor will. So that's what I like about not going public. I think your exit is either going to be your partner or one of its competitors, but your partner is going to help you get to that stage where you are saleable. Yeah, go ahead.
Hey,
right in the front, I didn't see you.
Great presentation. I really enjoyed it. I just want to go back to that first question about warranty. Can you comment on partnership models where you're partnering with your clients? to share the risk of the technology and that type of thing. And you know, the success or the advisability of that, or maybe some anecdotes from people who've tried that.
And I'm not quite clear on the question. In partnering with them in the sense of absorbing the risk on the royalty, or sorry, on the warranty, sorry, or?
Yeah, on the promise, right? So you've got a technology, it's innovative, it's not totally proven, and so offering a partnership model with your customer, direct customer, maybe. You're now sharing, they're sharing in the risk with you.
Yeah, okay, now I get it. So great question. And that often happens is when you have a partnership and you're an early stage company, a lot of the large partners understand that they're taking on some risk, and it's either in the agreement that you work out with them, or it's an unwritten understanding that's been almost 100% successful in my experience, where they know that if you run into bugs and you run into warranty issues, that they're gonna take on some of that cost. So again, use Clean02 as an example. When they ran into warranty issues or product part failures or whatever, Clean02 would supply the part, and Tokyo Gas would pay the shipping. The shipping was often more expensive than the part, but there was a real sort of great understanding and true partnership there. And I think is when you pick the right partner, that's part of the benefit of it, is they work with you. When you do a license, I've seen so many adverse license relationship. When the minute they get that license, they don't have the time of day for you. You're just an annoyance that they have to pay royalties to, and it's really unfortunate. I've seen that. Particularly, you know, large companies, small companies, and certain jurisdictions are pretty aggressive in their business style, whereas in Canada, I don't think that we are. So again, that's one of the downsides of licensing, is because you don't have aligned interests anymore. Your interest is hoping that they sell as much as they can, so you get a high royalty, and theirs is hoping that they can increase their cost and reduce the royalty that they have to pay to you as much as possible. I'm giving you the downside of it. You can find great licensees, but you really have to be careful. It's like Ashton said a million times, you better pick the right one.
Great presentation. I was fascinated by the water example as well. I'm curious, in that example, they wanted to sell their technology as a service, but instead they ended up having to sell it as a complete package. Have you seen cases that have gone the other way, where they've tried to sell it as a package and instead they end up selling it as a service?
Yeah, I have. It's when it does happen, it's often a better outcome for the technology company, but a lot of them, for whatever reason, it never dawned on them to sell it as a service. And when it does happen is when their equipment is fairly expensive, and so it's a large capex, and you'll find companies that just aren't interested in that, and so they want to amortize it basically over a period. And so the customer presents the option of, hey, can we just have you guys install it and own it and run it for us, and we'll pay you on a monthly basis. And that's, in my view, in the majority of cases, the better business model, because it means ongoing royalty, and I think it increases the value of your company.
And one thing I forgot to mention is on that, with those long-term service agreements, you'll then have a bankable contract that you can go to financiers and such with and secure debt financing against. So that's another common reason we're seeing more and more people go towards the as-a-service model, is because it can access that debt financing for you down the road.
Thanks. Just because you mentioned debt financing there, in terms of licensing, do you find that is typical, that you can get debt financing if you have strong licensees?
No, that would be a total boon to getting debt financing. As Ashton said, if you have a contract, especially a longer-term contract with a creditworthy counterparty licensee, you're in much better shape to get lender financing, because they're now looking to the credibility of the licensee as opposed to you. So, yeah, and that works the same way with partners as well. It's the same principle involved, but I don't want to sound like we're trashing licensing because there's great aspects to it. But again, we've just had some significantly negative experience with clients selecting the wrong licensee, and then it's a living hell.
Any more questions in the room? And I don't think we have any online, so that's a wrap.
Great. Thanks. I appreciate all those questions. I hope you'll come out and enjoy our next session. We'll drill a little deeper into each of these things. This was really high level, although it might not have seemed like that way sometimes, but I think you'll enjoy the detailed nature of the next sessions as well. Thank you.
Yeah, that's